Welcome to Resilience and Resolve with Lance Drury.
Hello and welcome to today's episode of Resilience and Resolve with Lance Drury, where we break down the complexities of the tax world, making it easier for you to navigate through the numbers and paperwork. I'm your host, Kevin Rosenquist, and today we're going to talk about offer in compromise versus installed agreements, what taxpayers need to understand. Lance, so great to see you again.
Good to see you as well.
What are two of the most common tax resolution programs the IRS offers taxpayers?
Well, I think you hit the nail on the head there. It's offers in compromise and installment agreements. Now, there's different types of installment agreements. Everybody wants an offer in compromise, but you have to qualify. You know, it's basically determined by the net equity in your assets and the difference between your income and expenses, except you're also relegated to the national standards. That's a list of expenses that the IRS compiles, and they put a number by it. For example, every county has a different number for housing and utilities, and you can't exceed that if your actual expenses are higher. What we're finding, particularly in the Nashville area as opposed to the St. Louis area, is that most people down there do not qualify for an offer in compromise because the real estate market in Nashville has gone haywire. People are coming in from California paying $200,000 over the listed price, and so they have too much equity in their homes to qualify for an offer.
Okay.
The other one is an installment agreement, and a partial pay installment agreement acts like an offer in compromise in that you never pay back the full amount, but it's over time. You pay it monthly. So you're not going to get rid of your tax problem completely right away. So that's why people prefer offers in compromise. There's also what's called a streamlined installment agreement, whereby you pay back the full amount, but you don't have to pay it in a lump sum. You pay it back over time.
Okay. That makes sense. So what types of tax debts can be settled through an offer in compromise?
You can settle all types of tax debts through an offer in compromise, payroll debt. However, it is very difficult for an existing business to have an offer in compromise accepted. It's not impossible, but it is harder than for an individual to get an offer in compromise. But obviously, we have to do the work to see whether or not people qualify. For example, if your debt is only $60,000, you have $200,000 in equity in your home, you're not going to qualify for an offer in compromise.
Right. Yeah. That makes sense. What other criteria does the IRS look at to evaluate whether to accept an offer in compromise?
Well, one of the things that they look at is your history. We had a gentleman once who qualified on the basis of his financial situation, but he had been non-compliant for so many years and owed between $500,000 and $1 million that the IRS would not accept his offer in compromise. Wow. The good news is he's not going to pay any of that back, but it's slowly fallen off over time because the IRS doesn't have forever to collect the tax.
Right. And so now, what are the eligibility requirements for setting up an installment agreement with the IRS?
Well, again, you have to do the financial analysis. For example, let's say that you owe $60,000. We go through the finances, we get the supporting documentation, and it shows you can only pay $200 a month. The IRS only has 10 years to collect the debt. So on a $60,000 debt and you pay $200 a month, that's only $2,400 a year. So even after 10 years, that's only $24,000, and that $60,000 is going to grow because of penalties and interest. I want to talk about this. I had a woman several years ago. She owed a little over $40,000. So we went through the financial statements many times, and it showed she could pay $600 a month, which means she would have paid about $30,000 of that back because it still had 4 years to run on the statute of limitations on collection. So I called her up. I said, "You need to go out and buy a new car." He goes, "They're going to let me buy a new car when I owe them all this money?" I said, "You got a car with 200,000 miles. You have no car payment. A reliable car is a necessary expense in determining your ability to pay this back." So she went out, got a car payment for $500 a month. She paid $100 a month for 4 years. So she paid less than $5,000 over time on a $40,000 plus debt.
Well, that was good advice then.
She was happy.
I'll bet. I can't imagine. So how is the payment amount determined in an installment agreement? Is it just like basically going through and saying what can they afford? Are there other factors that influence it?
No, it's basically what they can afford now. So basically it's the difference between your income and your expenses. However, they're not going to let you eat out every night. That's not going to be an allowable expense. You can't drink it away. You can't gamble it away. You can't give it away. You can't pay for your kids' college education, but just about everything else is an allowable expense. And as long as, you don't, but the problem is for the installment agreement, if you're in the automated collection system, they will let you exceed the national standards. However, if you get a revenue officer, they're much harder on allowing you to exceed the national standards. So if you have a $3,000 a month mortgage payment, you're likely not to get that accepted if you have a revenue officer.
Okay. And what types of tax debt can be addressed through installment agreements? Is it the same? Can it pretty much anything?
Yes.
There's no difference at all between the two?
No. Payroll tax, trust fund recovery penalty, income tax debt. Yeah, they can all be addressed by both of those avenues.
So when would you want to use one versus the other? What are the advantages and disadvantages, between the offer and compromise and the installment agreement?
Well, most people want an offer and compromise. And that's because it gets over quicker, because it takes about a year. And once you have fulfilled the terms of the offer, you're done. Now, the only time I would not advise somebody to do an offer is if they have a poor history of compliance, which means they're continuously going to accrue tax debt year after year, because one of the conditions of that acceptance is you have to have a clean record with the IRS for the next 5 years. Or guess what? The offer and compromise goes away and all that tax debt comes back. Okay. So that's the one instance where I would not recommend that you seek an offer and compromise. And most people want to do it because their problem goes away quicker. The liens go away once it's accepted. Everything's done. And if you get somebody set up on what's called a partial pay installment agreement, and you send in your tax return 3 years from now, and it shows you're making more money, they'll come back and say, you need to fill out new financials to see if you can afford to pay the IRS more of this debt back. So that's another drawback of having a partial pay installment agreement, is that they're free to come back every 2 years. Now, they don't do it all the time, and it doesn't happen all that often, but it may start happening more, because I just found out the other day, the IRS in 2025 is going to double the amount of money they spend on enforcement, which is good for me, because that's when people call, is when they're threatened with the levies. And in 3-4 years, it's going to be 6 times what it is now.
Wow.
And I don't know if we spoke about this before, but July was a record revenue month for the firm. And normally, people don't call me in the summer because they're going on vacation. They want a boat, whatever. They don't deal with their IRS problems. But this year was different because the IRS was actively levying people during that time frame. So we brought in more revenue in July of this year than we ever have.
Wow, that's interesting. And then it's going to double next year.
Yes, enforcement's going to double. And when those LT11 letters hit, which is the final notice of intent to levy, if the taxpayer doesn't do anything, they're free to wipe out your bank account. They're free to take 90% of your take-home pay. And the people that ignored those letters in August and September, they're going to get hit bad real soon. It's going to be like Milton. It's going to be like Milton.
Oh, wow. Well, if you're listening and you got one of those letters, take Lance's advice. Get on it. Don't just let it sit there.
Right. You can't ignore that.
Is it time to call an attorney at that point?
Well, the sooner you can call the attorney, the better. You don't want to get to that point.
Right.
Now, you can then, if you get to the attorney soon enough, stop the levy, and you've got 6 months to get your ducks in a row so that you can get your problem resolved, because it takes that long to get a collection due process hearing or an equivalency hearing, which is good because, you didn't get here overnight. I'm not going to get you out overnight. And it takes time to get those financial statements right. And we've got to get them right because you're submitting those numbers under penalties of perjury. And guess what? You give us bad numbers, we're going to give you bad advice. So we got to make sure the numbers are accurate.
Yeah. How you said that most people would prefer an offer of compromise over an installment agreement, but not everybody qualifies. What do you have like a rough estimate, like what percentage of people end up qualifying for that?
Well, it's very low in Nashville. My managing attorney there thinks only about 3% of our clients, because of the housing market down there.
Right.
Now, there's many more in the St. Louis area, but the problem is if you've got a lot of equity in your home, that automatically knocks you out.
Yeah, that same thing happened in Colorado where I am a few years ago, where all the people from California and out west were moving here and skyrocket the profit or the home values just skyrocketed.
Right. And that's what's happening in Nashville. People from California are coming in. They're paying $200,000 over the listed price, and it just drives everybody's fair market value up, but it doesn't do them any good to sell the property. If they want to stay in that area, they got to pay the same for the new home.
Exactly. That's kind of the catch-22 of it, right? Unless you're going to sell your house and move like to rural Kansas or something where it's cheaper. It's
unbelievable, but Nashville is the place to be in the Midwest now. It's just growing leaps and bounds.
Wow. I've been there. It's a very cool city. So I don't blame people for wanting to live there.
No, I don't blame them either. I enjoy Nashville very much.
Can you share any real life examples of maybe a successful offer installment or a successful installment agreement and why it was successful?
Well, I think I just gave you the one example of the woman with the installment agreement where it showed that the financial, she could pay $600 a month on a $40,000 plus
debt. You told her to buy a car.
Let me think about an offer in compromise. We've had lots of offers accepted, but I can't think of one off the top of my head. But we will not do an offer if we don't think it's going to work, because all you're doing is basically delaying a collection. And when you're in an offer in compromise, that stops the clock on collections. So the whole time that you're negotiating an offer of compromise with the IRS, the clock has stopped on the time frame for them to collect. So they're going to have that much longer to collect once the offer's over. So we really don't like doing offers unless we're going to be successful. They're a lot of work for us, a lot of work for the taxpayer. And, sometimes people don't want to hear it, but you've got to give them the truth. And if they are not a good candidate, you need to let them know that.
Yeah. Okay. That makes sense. So you don't even want to start the process if you're like, listen, it's not going to work. Trust me.
Right. And a good practitioner should not do that. I mean, it's sort of like pursuing something that's frivolous, and it's like you're just delaying collections when you do that. So you have some ethical concerns there as well as to why you should not initiate that process.
Yeah, that's a good point. So in what part of the process should taxpayers consider seeking professional assistance for an offer in compromise or an installment agreement? Like what point should they go, better call Lance?
Well, I think as soon as they get an LT-14 letter, which is the assessment, the initial assessment of the tax, they should call a practitioner, because you do not want to call them yourself. Mm-hmm. I have seen so many people just make matters much worse because they called the IRS. And what happens is they call them up, the IRS, it just puts them on their radar. They'll make unreasonable demands, give you unreasonable deadlines. So you're really behind the eight ball when you call the IRS directly. We have special software that goes into the IRS systems. They don't even know we're in there. And we can get a lot more information than they would ever tell us over the telephone anyway. Mm-hmm. And so, you need to call right away, because the more time that you have before that levy hits, the better off you're going to be.
What do you like people to be prepared with before they call you? What all should they have ready?
We're going to verify all this, because the problem is half the time in those initial calls, people don't have all the information about their case. Everything's confusing. They're complicated. Ideally, we'd want to know what years the liabilities for, how much, if there's any unfiled returns, what years are unfiled, have they received a levy, is there a revenue officer in the case, if they're self-employed, have they been making estimated tax payments? And most of the time, those self-employed people aren't making estimated tax payments. That's why 70% of my clients or more are self-employed individuals, because they don't make the estimated tax payments and they continue to pyramid liability. So those are the types of things that we like to have during the initial consultation.
And how quickly can you determine if someone's going to be able to qualify for an offer of compromise? Is it pretty fast?
No, not at all. This is where people get the biggest bang for your buck. The president of the American Society of Tax Problem Solvers, Larry Lawler, once said during a webinar that if you're not spending at least 9 months on your client's case, you're not getting your client the best possible result.
Wow.
And so here's the reason. Those financial statements are confusing. They're complicated to the average individual. They'll put down information that's not correct because they're guessing. They will have missing information. So we have to go back and forth 2, 3, 4, 5 times because we got to make sure the numbers are right. And some of those numbers we have to prove up with bank statements, credit card statements, debit card statements to prove that the expenses are what they say they are.
That makes sense. Any final advice on these for anyone listening that might be wondering what they should do next?
No, they just need to get out there and to get a practitioner as soon as possible. And I tell everybody there's 3 rules if you don't hire me. Number 1, hire an attorney that does this every single day. Attorneys have the skills and argumentation. That's what they're trained in. And they're much more client-oriented, I find, than accountants or enrolled agents. Accountants in particular, I've seen accountants give atrocious advice because 90% of what they do is tax preparation. It's not tax resolution. We spend $100 or more a year just keeping up on this. Number 2, go local. And number 3, don't hire one of the big boys. There's a lot of scam artists out there. So you got to watch who you hire. And a lot of those national companies, they just take your money and they don't do anything. I just had one the other day that had one of those companies, had them for 3 years, and they didn't do one thing for them.
Oh my gosh, 3 years.
Yep, 3 years.
That's awful. Well, that's good advice. Thank you for that, Lance. And thank you for tuning into Resilience and Resolve with Lance Drury. To connect with Lance, you can visit lancedrurylaw.com. And of course, don't forget to hit that like and subscribe button and stay up on all things tax law. Lance, thanks so much for being here. Really appreciate your time.
Thanks, Kevin. Hope to see you soon.
Thanks for watching. Be sure to hit that like and subscribe button and leave us a review in the comments.